Alright, we're going to go ahead and get started here. Before we get started, anybody have any questions on anything prior to this chapter? Are you actually a Michigan fan, or are you just wearing that just to burn me?
No, I'm actually Michigan.
Oh, man. No hate in this class. So. Yeah, I grew up in Columbus, so I can't help it. So. Anyway, sorry. When I see Buckeyes or Michigan stuff, mine goes elsewhere, so I apologize. All right, nobody had any questions leading up to this? Okay. All right, so we're going to talk today about accounting for corporations. And again, similar to what we've talked about already, when we are setting it out and talking about accounting for partnerships or sole proprietorships, corporations, bless you, or any type of business entity, when we're changing around the entity, most of the time, the only thing that's going to change is the owner's equity section. Okay, so much of what we talk about today will have to do with the owner's equity section and how that specifically relates to corporations. Okay, so to be able to talk about that, you'll have to forgive me. I've been kind of sick this weekend, so we'll see how long my voice lasts. On that note, I already posted the examples for today. I knew my voice wasn't going to handle a full hour and 15 minutes, so I posted that already. So we'll just look at the content today. So, but before we talk about the nature of corporations in the owner's equity section for the balance sheet in terms of accounting, we'll briefly talk about corporations in general. What are some advantages of organizing as a corporation, as a business person? Well, first of all, that's a decision that's going to be made kind of right towards the outset of you becoming a business, or later on down the road when you're already a business and maybe you decide, hey, we're getting bigger, we want to go public, we want to generate some more capital, so you might change and become a corporation later on down the road. Either way, you would normally choose to become a corporation because of these advantages that are inherent in the nature of being a corporation. One of those, it's kind of considered to be a separate legal entity. So you can own property in the corporation's name. Corporation pays its own taxes. It has a tax form, but it also pays a tax as an entity itself. The owners of the company, which are the stockholders, don't have liabilities about things that the company does other than the money they invested in the stock. Let's see what else. The main reason people become corporations generally is for this last one, which is ease of capital accumulation, which just means how easy is it for you to raise money. If you need extra money to grow, how can you get that money? Okay, do you have to go on Shark Tank to raise your money, or can you raise your money by selling stock? So usually people organize as corporations so that they can sell stock to raise money. Okay, I guess I should say a couple things about the disadvantages. Obviously, there's tons of regulations, especially if you are a publicly traded company, which equals a lot more cost. So that would be one major disadvantage. The other one being the fact that this is an entity unto itself means that the corporation gets taxed, but then if the owners get paid from the corporation as a dividend, that also gets taxed. So if you talk more in your business lives about corporate taxation at all, you'll hear the term double taxation with respect to corporations, which just means when the money comes into the corporation's pockets, it gets taxed. And then again, when it goes out to the individual shareholders, it gets taxed again. This is just a diagram of structure of corporate governance. Just how does the corporation work day to day? Who says what? Who's in charge of what? And basically, it essentially flows like this, but this doesn't really give you all that accurate of a view of what goes on day to day, because day to day, generally it's the bottom two, the president, VP, and other officers, and the employees that are doing the work. They're usually getting guidance from the board of directors, and then the board of directors is selected from a vote of the stockholders. So the stockholders generally, in most cases, aren't even voting on anything to do with what goes on in the company, other than really major changes in either the kind of corporate constitution, which is called a corporate charter, or for voting on these boards of directors. And then, of course, board of directors chooses the president, and then, well, depending on the structure of the organization, maybe more than that, but usually just chooses the CEO, and then the CEO would appoint essentially everyone underneath her. Okay, so when we talk about stock, typically there's a variety of types, but typically we break it down into two major categories: common and preferred stock. Okay, so again, we say one of the major themes in talking about corporations is the fact that they are owned by shareholders. So the shareholders' equity section is different, and the way that that's set out in the shareholders or stockholders' equity is by categories of stock ownership. So if you only have common stock, then you would just see a line that listed, much like this, total amount of common stock outstanding, value-wise. If you have more than one class of stock, then obviously you would have more than one line listing the ownership that's tied to that stock as a value. Anybody own stock in here? Yeah. Anybody actually have received a paper? You got your shares of stock. Did you get the actual paper? No. Everybody just does that now. It's kind of fun. Anyway, when you get stock, if you're buying actual paper stock, then these classes of stock are kind of stamped on the front there, and the classes of common stock or capital stock are par value, no par value, and stated value. You'll hear common stock and capital stock kind of used interchangeably, and that's just because the nature of common stock, well, it's called common stock because it's the most common type, but capital stock just means that you have voting rights. Okay, you have for common stock, you have voting rights, so you will, when they call a vote to appoint new board of directors or whatever the stockholders are voting on, you actually get to vote. As a preferred stockholder, which we'll talk about later, you don't get to vote. But within that category of common stock, you've got par value, no par value, and stated value. Now, par value and stated value are basically the same thing. Okay? The wording's a little bit different. There's some nuances that are different, but for the intents and purposes of this class, they function the same way. Okay? And that's basically par value and stated value are just arbitrary values that we've assigned to each share of stock. Okay? They have nothing to do with the actual market price of the stock, and maybe they have nothing to do with the market price ever. We may have just randomly set up and said, okay, this is a 1 cent or a $1 par value stock. And the choice of what value to put on that is well beyond the scope of this class. But in terms of accounting for stock, it's important to know which class the stock we're talking about, which type it falls into. Okay, so in this example, we've got par value. And for par value, basically, you'll notice that these journal entries all look very similar. When we sell stock for cash, remember the reason that we are selling stock at all generally because we need cash or we need assets. And so that's why we're willing to give up some ownership of the company, at least in terms of the type of ownership that we give up through common stock, and we want some money back. So we debit cash, and then this is the part, this is kind of a funny way of doing things. There's not really, at this point, any really easily explainable way or reason for doing things this way, other than whatever the arbitrary value we've assigned as the par value is, we're going to take that value and multiply it times however many shares we put out there. Okay? So in this case, we had $10 par value shares, and we issued 30,000 shares. So 30,000 times 10 is $300,000. So that is what goes into common stock. So if you're looking at the stockholders' equity section of the balance sheet, this is a line in that section, common stock, which captures the amount, the value of common stock that we have outstanding. And then there would be another line item in there called paid-in capital in excess of par value common. And common would obviously just distinguish that from other types of stock. But that's just kind of a value holder that says or recognizes the fact that no matter what value we gave the stock, the value of the stock is going to go up and down. So no matter what, it's probably not ever going to come in or very rarely going to be sold at exactly the par value. Okay? So if it's above par value, which is most often the case, then whatever the difference between par value and the cash that we got comes in as paid-in capital in excess of par value. Now, I said that par value and stated value are very similar. If this were a stated value question, it would look identical to this. The only difference would be this would say common stock, $10 stated value, and basically anytime you saw the word par value, you would exchange that for stated value, but it would look identical. Okay? Because stated value and par value are basically the same thing. The only difference is par value is actually written on the shares of the stock. Stated value, for whatever reason, is stated instead of written, but functions in the very same way. Okay. The next example, though, is when, that's a look at what the stockholders or shareholders equity section would look like after that last journal entry that we just did, this one. Now, this example is when there is, I thought I had another example in there before this one. Sorry. It's not. All right. Maybe it's in the example that I put up already. This example, very same thing, except now instead of cash, we got land, or substitute whatever random asset that you want to. Okay? So no matter what the asset is, it's still going to be a debit to that asset. So if people are trading assets for stock, they're trading in this land. In the corporation's eyes, that's a debit to the land account. So land goes up, and in exchange for that, we gave out this amount of ownership value, which was, again, well, I guess I should say before I move on, anytime, the only nuance when we're dealing with anything other than cash is the valuation. How much, what's the dollar amount I'm putting in there? Obviously, if it's cash, that's easy to know because it's, you just count up the dollars. If it's an asset, then you got to get some valuation. Typically, that's going to be market value, but I think most of the time you would just be given the value of the asset. Okay. So in this case, it would function. Once you've made that valuation, the rest functions exactly like what we just talked about, where we multiply the number of shares that we're putting out there times the par value, and then the difference is going to be captured in the paid-in capital in excess of par value. In addition to having the ownership rights to vote on items, and in addition to the fact that a lot of people buy a stock just because they hope that at some point that stock is going to appreciate in value and they will sell it for more money later. That's probably most often what you all think of when you think of investing in stocks. You think of stocks, buying it at a low dollar amount or a relatively low amount, selling it later for a higher amount, and reaping the profit benefit there. But there are people that also invest in stocks in order to, or they pick the stocks they invest in based on the amount of dividends that the corporations pay. So again, a stockholder, yes, stockholders are the owners of the company, but it's not like they have the same amount of control that like a sole proprietor would have, right? They're still very much out of control of what goes on with the company. But buying ownership interest in a company through stock is a way, if the company is one that pays out dividends regularly, it is a way to earn some return on your investment while you're still holding on to it. So, obviously if you're buying stock and waiting for it to go up in value, even if it goes up a ton in value, you don't get any of that until you sell your stock, right? You just get to say, hey, I have stock valued at X amount of dollars. But if you don't sell it before it comes back down in value, then you never captured that change in value. Okay? So dividends are another way to get value out of stock. At the end of the year, if a company has excess cash, which would typically go into retained earnings, they have a choice of whether they want to keep that money in the bank and use it to grow or whatever they plan on doing with the money. Maybe they have a bunch of debts to pay off, whatever. Or they can decide, hey, with this excess cash that we earned this year or that we built up over a number of years, we're going to pay our owners to make stockholders happy, to incentivize people to buy our stock, to drive the shares of stocks value up. So these would be cash dividends. So in order for a corporation to decide to pay dividends, they have to have those two things, sufficient balance in retained earnings, and also obviously the cash in their bank account to pay them. When we talk about dividends, there's three important dates: date of declaration, date of record, date of payment. Two of those require journal entries. At the date of declaration, when the corporation commits to paying a dividend, they incur the liability as of that date. Okay? So as of the date of declaration, you would record a journal entry that shows that you now owe your stockholders the dividend that you said you were going to pay. Okay? The date of record just means when you make this declaration, you will say, we're going to pay dividends to everyone who owns stock as of X date. Okay? So if you are a stock owner as of April 1st, then we will pay you a dividend. Okay, so that's the date of record. No entry required there. That's just for your own benefit of knowing whether you're going to get paid or not. And then obviously, when the actual cash goes out, you're going to record cash going down. So this is as of the date that you decide you're going to pay and you declare dividends. So as soon as that's kind of a buzzword, declare dividends. As soon as you declare dividends, you owe the money, and it comes out of retained earnings. Remember, we said you had to have sufficient retained earnings first, and then when you actually pay, sufficient cash. So this is the journal entry: debits retained earnings, credit to common dividend payable, or some type of dividend payable account. As of the date of record, again, no entry is required because that's just a kind of a record-keeping date. And then when we actually pay the dividends, we would just, as you should recognize from our time talking about liabilities, we're going to debit the liability account to lessen the amount that's in the liability account. So that would be the common dividends payable, and we would credit cash to show cash going down. Anytime that a company pays out dividends, and that's kind of a misnomer, because really, well, let me get into that. Anytime a company pays out more dividends than the profits that they've accumulated over prior years or from the current year, then you're actually going to tag the retained earnings. So basically you're going to take that deficit. So if in this case we had $6,000 above and beyond what was sitting in our kind of spare cash leftover earnings pile, which is our earnings and profits. So we paid out all of the spare earnings and profits that we had, and then in addition to that, we paid out $6,000 more. So since that wasn't from our earnings, we're saying that that was actually going to come out of shareholders' equity. It's actually a return of equity for that amount. Okay, that complicates the situation a little bit. We won't talk too much about that, but just know that anytime that we pay out more dividends than the accumulated earnings that we have ready to pay out, then that just becomes a return of capital. In addition to cash dividends, a company also has the option of putting out stock dividends. Okay, so if they say, okay, anyone who owns stock in the company as of X date, we're going to pay out, a 10% dividend. So basically, everything you had before, you're going to get 10% more stock on top of that. Okay. Why would they do that? Just another way to incentivize potential shareholders and keep shareholders happy. It's also a way to make the stock price stay a little bit lower. So if for whatever reason you don't want each one of your shares to be $5,000 per share, you could just push out a bunch of shares to your current stockholders in the form of a stock dividend, which would essentially just dilute the value of their shares, except that everybody's shares would be diluted equally, so nobody would have a change in their ownership percentage, just each individual share in the company would be worth a less percentage of the company, so it would be valued less. Again, these are all complications that we're not going to get into. You should just know in general what a stock dividend is, a way to keep shareholders happy, and just know that if we had $20 talking about stock splits. I'll get that word out. Stock splits are where we're basically, it's essentially a type of stock dividend, but it's where you're doubling or cutting the value of each share in half. So you have twice the shares, half the par value. Okay? So less than a full split would just be a percentage stock dividend. But they all function the same way, right? If I'm an individual who owns 100 shares in this corporation, and each share has $20 par value, after the split, I would own 200 shares, but they would each have a $10 par value. So my overall value that I own in the company would not change. It would just be divided between twice as many shares now. Okay? So anytime a stock splits, at that moment in time, it's kind of a it basically does nothing to the value of your stock. You have twice as many shares of stock, but each one's worth half as much as it used to be. All right, so now we're moving on to talk a little bit about preferred stock. First of all, why is it called preferred? It's called preferred because it is preferred in the pecking order to common stock. So if you have to prioritize, then preferred stock would be above common stock in two important areas. One, whenever we're talking about paying dividends, and two, when we're talking about paying off what we owe stockholders if we have to liquidate. Okay, so if for whatever reason we have to go out of business tomorrow, we turn everything we own into cash, we pay off all of our liabilities, and then we start distributing money out to stockholders. Okay, we distribute that money out to preferred stockholders first until they get all their equity back. And then whatever's left gets distributed between common shareholders. Okay. In addition to that, if we're going to pay out dividends, we pay preferred dividends first, and then what's left, yes, sir.
Would that mean that in a lot of cases, seeding your company, you have been done for it to be more profitable than the still company?
Say that again. Doing what to the company?
Seeding your company around really things
Oh.
that actually paying you a lot more than the company running with.
Yeah, it just depends on the scenario, but there are definitely times when that would be true. That is true. Ultimately, though, obviously, if you invest in a company, your hope is that the company will grow exponentially, and that will be where you get most of your value from. Okay, so with preferred stock, generally it has a stated dividend rate. So each year there's an expectation, let's say it has a 10% dividend rate, that whatever the par value on that stock is, that you will get 10% of that each year. Okay, that's the theory. In actuality, it just means that the company owes that amount to preferred shareholders each year, and that they can't pay any dividends to common shareholders until they pay the ones that they owe the preferred shareholders. Doesn't necessarily mean that you're guaranteed that amount each year, but you have a much better chance of getting it dividend if it's a preferred stock. When we're talking about preferred stock, cumulative versus non-cumulative, this is two categories. It's just kind of adding a further nuance to this. But basically, non-cumulative just means if you've had years that you didn't pay what you owed your preferred stockholders, at the end of that year, it goes away. Okay? So each year, if you don't pay your preferred stockholders this year, it means you don't get to pay your common stockholders any dividends. But it doesn't mean anything for next year. Next year, we'll look at individually. If you have cumulative preferred stock, then each year that you didn't pay your preferred stockholders the dividends that you owed them, each one of those years, that would just go into an IOU. And at the end of the day, before you paid any other dividends, you would have to pay the ones in that IOU category. So it's just a look at what that would look like if we had non-cumulative versus cumulative in those two scenarios. Pretty self-explanatory. In the years when we have, or in the situation where we have cumulative, our first step is to clear the previous year's dividend in arrears, the amount that we didn't pay for previous years, and in this scenario, we don't have to do that. That would be the only difference. Treasury stock. Okay, this kind of got messed up, this particular slide, but treasury stock is just stock that a company has sold to people or put out there to the public, and then gone and purchased back from the public for any number of reasons. Okay, one reason to do that would be if you want to increase the value of the shares that are out there. One way to do that really quickly is to make the number of shares you have outstanding less. Okay, one way to do that is to go and buy some of the shares back. Another reason would be if someone's trying to take over your company in a hostile takeover, which is basically where they're just going around behind your back, buying up shares of the company until they have a controlling interest, at which point they can get rid of everybody. So if you see someone doing that and you want to avoid that happening, then the corporation itself could go out there and buy back some of the shares to ensure that it holds control of its own destiny. Whatever the case may be, the scenario is, for treasury stock, basically when you buy it back, whatever value you bought it back for, that becomes its new value, or I don't want to say par value, but it essentially kind of functions like a new par value for it. So when we buy it back at $11.50 per share, like in this case, then that is the amount that goes into our common stock shareholders' equity area and to cash, almost as if this would be the scenario if there was no par value, or if the par value was exactly what we sold it for. So in that case, later on down the road, if we sell it for that exact amount, $11.50 per share, then it's treated as the same scenario as if we had sold stock for its par value. Okay, if we sell it for more than the $12 per share, then again it functions very similarly to as if that $12 per share was the par value. In which case, anything above and beyond that $12 per share, which again I got just because that's what I paid in the open market for those shares when I bought them back, anything above and beyond that becomes paid in capital treasury stock, which again is just like paid in capital in excess of par. Statement of stockholders' equity is just a slightly more inclusive statement of retained earnings that has these various categories in it. Stock options. Stock option, and of course, all this stuff I'm sure you'll cover in much greater detail when you take Intro to Finance. But stock options are just the option, so the ability to purchase stock at a given price later on down the road. So if stock's selling for $30 a share today, and I say, hey, here's the stock option to buy this stock at $30 per share, and it's good for 6 months. Then in 6 months down the road, if that same stock's worth $100 a share, but I have the option to buy it at $30 per share, then you can see how that would be something that would be of value to me. Because I have the option, I don't have to exercise the option. In other words, I don't have to buy it if it doesn't make sense, but I have the option of buying it much less than the market value of the stock. And of course, I could turn around and sell later for much greater. Yes? I mean, every company is going to do it differently. I mean, a lot of it's going to depend on the reason behind putting stock options out there in the first place. A lot of the places you see stock options are in like executive compensation, where you say, okay, you're the CEO, we will give you X amount of stock options if the company performs this well. So those types of options are usually have some type of vesting period where you say, hey, yeah, we're going to give you this option, but you have to wait X amount of years to exercise. Really, there's no set time limit. If you got an option, theoretically, you could exercise it that moment. However, the passage of time is usually what makes stock options valuable, because usually you're given the stock option at whatever the current market value is of that stock, and then it only becomes valuable to you as those stocks go up in value later on down the road. All right, that's the end of Chapter 13. Anybody have any questions on Chapter 13? Like I said, I did some examples from this chapter, already recorded them, posted them. Slides are also posted. If anybody has any issues or questions, let me know. Otherwise, I will see you all next week. How's the bike function?
Future that
Hey, at least that book doesn't have
I don't know. Savannah is like, I would love to live there. Thank you. Have a good day. Go Buckeyes.
Oh, nice.
Bonus points. Buy a used electronic version.
What's that?
You can't buy a used electronic version.
True. That's what I mean. I guess that's why I'm looking at cheaper. The new paper one.
Well, yeah, I think
It's incentivize because otherwise, I got it.